Welcome back to the deep dive. If you track wealth management, you know consistent performance, like every single quarter, it's tough, really tough. Most firms, well, they just ride the market waves. Very few seem to actually navigate using a clear strategy. So today, we're doing a deep dive into Anand Rathi Wealth Ltd, ARWL. We're looking at their recent Q2 and half-year results for FY26, so that's the period ending September 2025. We've gone through the earnings calls, the press releases, the investor decks, and our mission here isn't just, reporting the numbers. We want to pull out that core strategy, the repeatable process that seems to make them almost immune to market swings.
Yeah, and that resilience, that's really the big story right from the start in these documents. This is their 16th consecutive quarter of consistent growth, and they keep calling it market-agnostic performance. That phrase is key because, look, during this period, the Nifty actually dropped about 3, maybe 4%. They grew while the market shrank. That tells you something internal is driving this, not just a rising tide.
Okay, let's put some scale on this growth then. Where's the money coming from? Their assets under management, the AUM, hit 91,568 crores. Just for perspective, that's around, $11 billion US? And up 22% year over year. And think about this, at their IPO maybe 4 years back, they were at roughly 30,200 crores. So nearly triple. It's a staggering trajectory.
It is staggering, yeah. But, what's maybe more telling than just the size of the AUM is the efficiency behind it. Let's look at the financials. Total revenue, up 19% year over year, reaching 591 crores. Okay, good.
Yeah.
But their profit after tax PY that jumped 29% year over year to 194 crores.
Oh, okay, so profits growing faster than revenue. That points to leverage, right?
Yes,
operational leverage.
exactly. Positive operating leverage. They're getting more efficient optimizing costs, so more of that revenue increase falls to the bottom line. And that efficiency, that's why their annualized return on equity, the ROE, is just, frankly, through the roof at 45.5% for this first half. That's really a hallmark of a disciplined, asset-light kind of business model.
And they seem way ahead of their own targets, too. The numbers show they've already hit like 50.3% of their full-year revenue guidance and 52% of their full-year profit guidance. I mean, that pace feels almost suspiciously good. Which brings me to that question from the earnings call about their AUM target. They're nearly at 92,000 crores now, right? But they kept their aspirational guidance pegged at 1 lakh crore. Why not raise it?
Yeah, it does sound a bit conservative, doesn't it? Management's line was the classic, undercommit and overdeliver. They said AUM is volatile, and look, their base case models only assume maybe 9 or 10% market growth generally.
Okay, undercommit, overdeliver. But if you're consistently beating your targets by this much, isn't it starting to feel less like caution and more like sandbagging? Especially for a company that talks so much about precise metrics and risk adjustment. It feels like they're managing expectations down.
Well, that's the slight tension you see, right? They say conservative, but the results, they scream much higher internal expectations. And look at the interim dividend they just declared, 600 per share. That's 120% of the face value. That's the company basically saying, non-verbally, yeah, we're crushing even our own internal numbers. The results don't lie, even if the public targets seem modest. Okay, so let's pivot a bit from the financials to the engine driving it, the clients and the relationship managers, the RMs. What's really fascinating here is how they pulled in these net inflows. We're talking 6,827 crores in H1 FY26. That's up 20% year over year. And this happened precisely when market sentiment was, pretty poor.
Right, countercyclical.
Yeah.
And it's serious money. You mentioned the equity mutual fund flows for Q2 specifically. They jumped 101% year over year to 2,062 crores, compared to a quarter of the previous year when sentiment was, and I'm quoting them, significantly better.
Exactly. It backs up their whole philosophy, which they state quite clearly. Buying when the sentiment is bad creates a lot of value for our clients. They're not chasing momentum. They seem to be coaching clients to stick to the plan, be disciplined, and you can see it working in their market position. Their share of the total equity mutual fund net flows in India, it went from just 0.16% back in FY20 all the way up to 2.33% in this first half, H1 FY26. That is a massive gain in penetration.
And that discipline, that value proposition, it leads to maybe the most jaw-dropping number in the whole report, the client loyalty metric. Active client families grew, 16% year over year to almost 12,800, but the attrition rate, measured by AUM loss from departing clients, it was just 0.18% for the half year, 0.18%. That number just it seems to defy gravity in this industry. If, say, 100 clients leave, they only lose the assets equivalent to less than one of those clients. Is that metric defined standardly, or is there something specific in how they calculate it?
No, it's genuinely remarkable. Direct comparisons are always tricky, but
Yeah.
anything under 1% in wealth management is typically seen as exceptional. So 0.18%, it signals incredibly deep client satisfaction, real stickiness. And look, this doesn't happen by accident. It's a direct result, they argue, of their core strategic promise, which they actually measure. They use Jensen's Alpha. And they apply a similar logic to their RMs, their advisors. Even when an RM leaves, they manage to keep a huge chunk of that RM's client assets, somewhere around 79 to 82%,
Wow.
which tells you the relationship isn't just with the person, it's with the firm's process, the system, the demonstrated value. Management explicitly links this retention success to showing superior risk-adjusted value.
Okay, so let's unpack that. Jensen's Alpha. For anyone listening, this seems to be the core of why this company works, why clients stick around. It's not about just getting the highest possible return, right? It's about the return you get for the amount of risk you take on. So what's a specific goal with Alpha?
Exactly. They use alpha as their key performance indicator, their objective measure of success. The goal, they state, is to deliver a 13% to 15% return for the client. But, and this is the crucial part, while keeping the portfolio's beta low, specifically around zero point 0.6 or zero point 0.7 relative to the Nifty index.
Okay, beta. Remind us quickly. That's volatility compared to the market.
Right. If the Nifty goes up 10%, a beta of 1 means your portfolio roughly matches that. Their target of 0.6 or zero point 0.7 means they aim to capture maybe 60–70% of the market's upside. But here's the flip side, the insurance policy. When the Nifty fell 3–4% last quarter, that low beta meant their clients felt much less of that pain. Alpha is the extra return they generate above what that low-risk profile would normally predict. It's the value add from their strategy.
Makes sense. Prioritizing safety, smoothing out the ride, rather than just chasing peaks. And they have a number for it.
They do. They report that the overall ARWL strategy delivered a Jensen's Alpha of 6.56%. That's calculated over a long period, from April 2014 right through to September 2025. And this isn't just some academic exercise. Their own client survey showed that risk-adjusted return, top priority for 93% of their investors. They're delivering what clients say they want most.
Okay. So how do they actually achieve that low beta and positive alpha? Because it's got a product allocation, doesn't it?
Absolutely. It's very deliberate. They aim for roughly a 50–50 split in revenue streams between traditional mutual funds and other liquid products on one side and structured products, or SPs, on the other. Right now, they said they're sitting around 43–44% coming from those structured products and similar alternatives.
Structured products. Okay, let's dig into these because they sound key. The company defines them as basically a bond, but the return varies based on an underlying index like the Nifty. How does that act as a plan B and help lower the overall portfolio risk, the beta?
Well, they're typically designed with capital protection features. So you might get participation in the market's upside, but often it's capped. In return, you get some kind of floor, maybe principal protection or a minimum guaranteed return, even if the market falls significantly. That dampens the overall volatility. It's crucial for keeping that beta low.
Okay, but here's where maybe a little skepticism is healthy. Management made a pretty bold claim on the call. They said 100% of the 159 structured products that have matured since December 2020 gave the maximum possible return stated in the product. A perfect track record. That sounds almost too perfect, like maybe cherry-picked data. Or is that genuinely the full picture for matured products in that time frame?
Look, it's a phenomenal number, and the source is presented as comprehensive for all matured SPs in that period. It's definitely a strong selling point. But you're right to be thinking about risk. The analysts on the call push back on this, specifically on concentration risk, because historically, their primary issuer for these products has been an internal group company, Anand Rathi Global Finance.
Right. So are they diversifying?
They said diversification is a big yes. It's necessary if they want to scale the strategy further. They mentioned they've approved another external issuer, a company called New Mama, and they detailed their strict criteria for evaluating any NBFC that issues these products. Things like requiring at least half the capital raised to be invested, not just lent out, to ensure there's real liquidity back in the product. So they're trying to scale it and de-risk the counterparty exposure simultaneously.
That focus on risk mitigation seems woven into everything they do. Okay, so looking ahead, how does this sort of calculated risk engine view the wider Indian market? To sustain 20–25% growth, They must have some pretty bullish underlying assumptions, right?
Oh, absolutely. Their forecast is very specific and, yes, extremely bullish on India. They state there's a 90% probability, 90, that the Nifty index will deliver greater than its historical median return over the next 3 years. And they define that median return as being somewhere between 11% and 13% historically. So they're expecting strong performance.
90% chance of above-average returns. Wow. Okay, what about the downside? Do they see any major risks looming?
Interestingly, they rate the probability of a catastrophic fall, which they define as the market dropping more than 15% as being near zero right now.
Near zero. Why so confident?
They give three main reasons. One, margin funding books across the industry are apparently quite light. Less leverage means less forced selling in a downturn. Two, foreign institutional investors, the FIIs, they've already done a lot of selling in previous periods, so they're perhaps less likely to trigger a panic now. And three, domestic institutional investors, the DIIs, like mutual funds and insurance companies, are, in their words, loaded with money, ready to buy dips and provide support. They see the market as structurally quite sound.
Okay, if they're that bullish on the market and confident in their process, how do they plan to keep delivering that 20-25% growth? Especially as their AUM base gets bigger and bigger, approaching that euro lakh crore mark. Can they do it just by doing more of the same without some big new initiative?
That's exactly their argument. They rely on what they call their four engines of growth, and they're mostly about internal optimization and scaling the existing model. Engine one is just the implied return on the existing AUM. As markets rise over time, their fee income grows naturally. Engine two is leveraging their existing relationship manager capacity. They actually estimate their current RMs could handle about 6,000 more client families without needing significant new hires. That's pure operating leverage.
Right, getting more out of the existing setup. What's engine three?
Increasing wallet share. So going deeper with their current clients, capturing more of the assets those clients might currently hold with competitors or elsewhere.
Makes sense. And the fourth engine?
Is simply adding new RMs. But they emphasize doing this deliberately, focusing on training and developing talent internally rather than just expensive hiring from competitors. It's about scaling the process and the culture.
And alongside these core engines, we saw mentions of their adjacent businesses also growing quite nicely. Their digital wealth platform, aimed at the mass affluent segment, that AUM grew 21% year over year to over 2,200 crores. And OFA, their software platform for independent financial advisors, that now has almost 6,800 subscribers.
Yeah, and crucially, looking even further ahead, the board just approved setting up a subsidiary in Gift City out in Gujarat. Plus, they mentioned they're actively exploring licenses in the UK and potentially other international markets. Management didn't frame this as some immediate big bang, but more as the right things to do now to lay the groundwork to protect future growth options and serve clients globally down the line. They're building the infrastructure preemptively.
So if we wrap all this up, the big takeaway from this deep dive seems clear. This consistent, market-agnostic performance, it's not luck, it's not just riding a bull market.
Yes. No, absolutely not. It appears entirely driven by a very deliberate, highly measurable, and incredibly detailed process. You could almost say the process is the product. And that process revolves around quantitative risk management, hitting that superior Jensen's alpha, which then translates directly into that phenomenal client loyalty, that 0.18% AUM attrition. It's all connected. It's a system.
Right. Which leads us maybe to the final thought for you, the listener, to mull over. India's wealth management market is huge and growing fast. This firm clearly has ambitions. They talked about creating 1.25 lakh crores in MTM gains for clients over 5 years. But the question is, how long can a company maintain this incredibly hyper-focused, numerically driven, process-heavy culture as it scales, especially as it blows past that euro lakh crore AUM mark and competition inevitably intensifies? Does that kind of process rigidity eventually become a bottleneck? Does it hinder the agility you might need later on? Something to think about. That's our deep dive for today. Thanks for joining us. Keep exploring.